Welcome back to AlgoBot, the channel where we take apart automated trading systems and study how they actually think. I'm your host here at AlgoBot, and today we're exploring an expert advisor for MetaTrader 5 called Daily Open Gravity Fade. This is a mean reversion strategy built around one simple, fixed reference point, the current trading day's opening price. Over the next few minutes, you'll learn how it measures stretch using the average true range, how it decides when price has drifted far enough to fade, and how it manages its stops and targets. This is educational content only, so let's dive in. Let's start with the big picture. Daily Open Gravity Fade belongs to a family of strategies known as mean reversion systems. The core idea is that in balanced, ranging market sessions, price tends to be pulled back toward a central reference level again and again, much like an object being drawn back toward a center of gravity. That's where the name comes from. What makes this approach distinctive is the reference it chooses. Instead of a moving average or a volume-weighted price that constantly shifts, it uses the current trading day's opening price. That's a static, fixed line that every intraday participant can see on their own chart. Because it doesn't move as the session unfolds, it becomes a shared reference point that price often gravitates back toward. The strategy rebuilds this day open anchor at the start of each new calendar day, taking the opening price of the first closed bar of that date. It reads nothing from a higher time frame. Everything is aggregated from the primary time frame bars you select. To decide when price has stretched far enough to be worth fading, the strategy uses the average true range, or ATR, a standard measure of recent volatility. It expresses the distance between the latest close and the day open in ATR units. A move of a small number of ATR away from the open is treated as a stretch that may reverse. But a stretch on its own is not enough, because a strong trending session can keep running and running. So the strategy adds an outer guard band. If price has already extended beyond that outer limit, it steps aside rather than fading a possible runaway move. In terms of who this is designed to study, it's aimed at liquid foreign exchange majors on intraday frames, such as the euro-dollar or dollar-yen on the 15-minute to 1-hour charts. Remember, trading always involves risk, and losses do occur. This is educational information, not financial advice. Now let's walk through the exact logic, step by step. The strategy acts once per newly closed bar on your chosen time frame. When a bar closes, it looks at that just closed bar, which it calls the signal bar. First, it maintains the day open anchor. Whenever the signal bar belongs to a new calendar date, the strategy records that bar's opening price as the day open for the rest of the session. Next, it measures volatility with the average true range over the ATR period, which defaults to 14 bars. It then calculates a value it calls Z, the signal bar's close minus the day open, divided by the ATR. This gives the signed stretch from the open, expressed in ATR units. A negative Z means price is below the open. A positive Z means it's above. For a long setup, three things must line up. The stretch Z must be at or below the negative of StretchAtr, which defaults to 1.2, meaning price is at least that many ATR below the open. At the same time, Z must stay at or above the negative of MaxStretchAtr, the outer guard set to 3.5, so the move is stretched but not a runaway. And the signal bar itself must be bullish, closing above its own open, suggesting the pull back toward the open is beginning. When all three hold, the strategy signals a buy. It targets the day open as the take profit and places its stop loss StopAtr times ATR below the entry, StopAtr defaulting to 1. The short setup is the mirror image. The stretch Z must be at or above positive StretchAtr, price extended above the open, while staying at or below MaxStretchAtr. And the signal bar must be bearish. The strategy then signals a sell, again targeting the day open, with the stop place StopAtr times ATR above the entry. Before any order goes out, two more checks apply. The current spread must be no wider than max spread points. And the setup must pass the min-reward risk filter, defaulting to 0.7, which rejects trades where price has already drifted so close to the open that the target no longer justifies the ATR stop. Finally, only one position per magic number is allowed, so the structural stop and open target manage the exit. Let's read through the code as it appears in MetaEditor. At the top are the input parameters you can adjust. ATR period sets the volatility lookback that scales both the stretch measurement and the stop. StretchAtr is the inner threshold, how many ATR away from the open before a fade is considered. MaxStretchAtr is the outer trend guard that skips fades once price has extended too far. StopAtr sets the stop distance. Min-reward risk sets the minimum reward-to-risk ratio, and max spread points filters out widespread conditions. Lots and magic control the trade size and the identifier. Just below, the code computes Z, the signed stretch from the day open in ATR units, and two simple booleans that tell us whether the signal bar is bullish or bearish. Now look at the long block. The condition checks that Z is at or below minus StretchAtr, still at or above minus MaxStretchAtr, and that the bar is bullish. If so, entry is the ask price. The take profit is set directly to the day open, and the stop loss sits one stop distance below the entry. The reward to risk check must pass before the trade.buy call is sent. The short block mirrors it exactly. Z must be at or above StretchAtr, at or below MaxStretchAtr, and the bar bearish. Entry is the bid, the take profit is again the day open, and the stop sits one stop distance above. Once the reward to risk filter passes, the trade.sell call goes out. Let's walk through this illustration candle by candle, and follow both a long and a short example in sequence. The gold horizontal line running across the chart is the day open at 1.0855. That's the fixed reference this whole strategy is built around, the gravity center that price will be measured against all session. The green dashed line below it marks the lower fade band, and the red dashed line above it marks the upper fade band. Those bands represent the inner threshold, roughly 1.2 ATR away from the open, where the strategy starts to consider a fade. Look at the opening candles. Price starts right at the day open and then begins drifting lower, one candle after another, pulling steadily away from the gold line. By the third candle, it has pushed down through the lower fade band. So the just closed bar is now stretched more than 1.2 ATR below the open, yet it hasn't reached the outer guard limit. Crucially, that same signal bar closes higher than it opened, a bullish bar, which the strategy reads as the first hint that the pull back toward the open is beginning. All three conditions line up, and the buy entry marker appears. At that moment, the strategy sets its target directly on the day open, the gold line above, and places its stop a set distance below the entry, scaled by ATR. Before it commits, it checks the reward-to-risk ratio against the minimum of 0.7, making sure the target is far enough away to be worth the stop. Here it passes. Now watch the next two candles climb. Price lifts off the lows, works back up through the fade band, and by the fifth candle it reaches the day open, where the take profit sits right on the gold line. The magnet did its job. Price returned to the open, and the long example completes. Now the mirror image sets up. Price doesn't stop at the open. It keeps pushing higher through candles 6 and 7, running up and away from the gold line in the other direction. By the eighth candle, it has stretched above the upper fade band, more than 1.2 ATR above the open, but still inside the outer guard. And this signal bar closes lower than it opened, a bearish bar, hinting the upward stretch is rolling over. The conditions for the short align, and the sell entry marker prints. This time the target is again the day open, sitting below the entry, and the stop is placed a set ATR distance above. The reward to risk filter checks out. Follow the candles that come next. Price eases lower through candle 9, then candle 10, sliding back down toward the gold line. By the 11th candle, it settles right on the day open, and the take profit at the gold line is reached. The short example completes. Notice what both trades had in common. Neither one chased the move. Each waited for price to stretch past the fade band, confirmed a bar turning back the other way, and then targeted the very same magnet, the day open. The outer guard band is what keeps the strategy from fading, a runaway extension that never returns. That's the whole rhythm of daily open gravity fade. And of course, not every setup resolves this cleanly. Some fades reach the stop instead, and that's a normal, expected part of any strategy. This is educational information only. So that's daily open gravity fade. We covered how it anchors to the current day's opening price, how it measures stretch from that open in ATR units, and how it fades overextensions back toward the open while an outer guard band keeps it away from runaway trends. We also read through the code and watch both a long and a short example play out on the chart. As always, everything here is educational information only, not financial advice, and not a recommendation to buy or sell anything. Trading carries real risk, and losses are part of the process, so study any approach carefully and test it thoroughly for yourself. If you found this breakdown useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling me which strategy to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.